If I had to start from zero in 2026, no portfolio, no complicated products, just a paycheck and a willingness to be boring, I would not look for the hottest tip or the cleverest chart. I'd build a tiny operating system I could carry while tired. Successful investing isn't a talent contest, it's choreography. The market pays people who can keep simple promises on a schedule, especially when the news is loud. So this is exactly what I would do, in order, with enough detail that you can copy any piece tonight and feel the weight on your shoulders drop a little. First, I'd make sure investing is actually investing, not a wish. That begins with plumbing. I'd route income into a quiet staging account with no card attached. On dates I won't forget, the money would leave automatically to do 4 jobs. One lane would pay the roof, utilities, phone, internet, transport, childcare, insurance, and minimum debt payments. It would also drip small amounts into buckets for the predictable irregulars that ambush most households: tires, travel, gifts, school fees, registrations, annual renewals. So surprises stop pretending to be emergencies. Another lane would feed a sleep fund because nothing wrecks an investing plan faster than a broken washer and a nervous system. A third lane would invest on payday before lifestyle hears the news. The fourth would be a weekly card that covers groceries and ordinary life and resets every Friday so drift lasts no more than 6 days. This is dull by design. Dull is durable, and durability is what compounding buys with your patience. Then, before buying a single fund, I'd write a 1-page investing policy in my own words. Markets shout, policies whisper. On that page, I'd answer 6 questions. What do I own? Broad, low-cost index funds that give me tiny slices of thousands of companies across sectors and borders. A matching, simple bond sleeve sized so I can sleep when screens go red. How much do I add? A fixed % of every paycheck, on the day it arrives. When do I rebalance? Twice a year, birthday and half birthday, so fear and greed can't hijack decisions. I'd allow a 5-point tolerance band so I'm not micromanaging. What do I do with distributions? Reinvest while building. How do I treat employer stock? Sell as it vests by rule. Cap any single company at a tiny slice of net worth so my livelihood and portfolio aren't the same bet. And what do I do when prices fall by a third? Keep contributing, rebalance once, go for a long walk. 1 page is enough to keep me from throwing years of future returns into a one-day panic. With policy in hand, I'd fix the 2 enemies of compounding: high-interest debt and unpredictable cash flow. If I carried any balances above a safe return threshold, credit cards, payday loans, anything with a rate that makes my stomach clench, I'd automate minimums and aim a small, relentless extra at one target balance until it expires. I'd pick either the highest APR, math win, or the smallest balance, momentum win. Both are fine, consistency is the point. In parallel, I'd aim the sleep fund at 1 month of essentials, then 2, then 3 as life gets bigger or income becomes variable. I cannot overstate this. An emergency fund is not a detour from investing. It is the road that keeps investing alive when life gets loud. Only then would I decide my starting mix. If I'm early in my career and can sleep through volatility, I'd begin with a heavy equity allocation, global stocks as the core, accessed through 1 or 2 broad index funds that charge a whisper in fees. I wouldn't gamble on single countries, sectors, or factors at the beginning. Breadth is my friend, and humility is cheap. If markets scare me or my horizon is shorter, I'd add ballast, short to intermediate government or investment-grade bond funds with low costs and low drama, so that a red screen doesn't trick me into selling the future to protect my mood. The mix is not a personality test, it is a sleep test. If I can't sleep, I will override the plan. If I can sleep, I can obey dates. As for the mechanics, I'd set my contributions to leave on payday automatically because desire is unreliable and direct deposit is not. I'd start with a number I can keep while tired. 10% is a classic opening, then nudge it a notch with every raise or windfall until I hit a rate that gives me a real slope. The raise would route through rails for 90 days before lifestyle hears the news. The sleep fund thickens, contributions bump, predictable irregulars get pre-funded, and I choose one small designed joy so the change sticks. There's no heroism here, just repetition that outlasts moods. Tax shelters matter, but I wouldn't get stuck in analysis paralysis. I'd use the local equivalents of retirement accounts, employer-sponsored plans, and long-term tax-advantaged wrappers first, especially if there's a match, which is salary wearing a different hat. Then, taxable accounts for the overflow, with tax-efficient index funds I rarely touch. If I had self-employment income, I'd pick the simplest compliant plan and wire contributions into my rails so they leave on dates rather than vibes. The goal isn't to memorize a tax code, it's to move ownership out of the blast radius of taxes where the law allows and then stop fiddling. On the investing side, I'd keep my core embarrassingly simple. One global stock index fund plus one high-quality bond fund can carry a beginner for decades. If I wanted spice later, I'd earn it. I'd add a small satellite only after a year of perfect core behavior, maybe a little tilt to small caps or a sliver of a broad real estate fund, capped so it couldn't hijack the ride. And I'd write that satellite's purpose on the same page as my policy, with an exit rule that doesn't require future me to be a genius. Boredom with the core isn't a sign to make it complicated, it's a sign that the plan is working. I would not chase individual stocks unless I was ready to treat them as entertainment with tuition. If curiosity is strong, I'd create a tiny sandbox sleeve, money I can afford to lose, that lives in a separate account and has no permission to borrow from the core. I'd cap it at an amount I'd be willing to see go to zero without changing my sleep or my contribution rate. That firewall is not prudishness, it's respect for future me who will have bigger goals than proving I picked a winner on the internet. Costs are not small, fees are gravity. Every 0.1% I give away for the next 30 years. I'd prefer index funds and ETFs with low expense ratios, avoid unnecessary trading, and buy funds that don't tax me for existing. I'd automate rather than time the market. Dollar cost averaging is not magic, but it is a ritual that doesn't require courage on bad days. And I'd resist the seduction of complexity dressed as sophistication. The world's biggest pools of capital earn their keep by being broadly diversified, low cost, and disciplined. I don't need a special trick when the basic trick works fine at human scale. Rebalancing deserves its own paragraph because it's where most investors either freeze or fiddle. I'd pick 2 calendar dates, birthday and half birthday. And on those dates only, I'd check whether my allocation had drifted beyond my tolerance band. If it had, I'd nudge it back using new contributions first and simple exchanges second. If it hadn't, I'd do nothing. The phrase "do nothing" is where the excess returns hide. Not because inactivity is heroic, but because many of the worst outcomes in investing are voluntary. Risk is not a villain, mismatched risk is. The market will drop, it always has. My job is not to predict the storm, it's to own a boat I can sail in it without jumping overboard. That means avoiding concentration bets, aligning my bond sleeve with my need for ballast, shorter duration if rate moves shake me, higher quality so bonds behave like bonds during equity sell-offs, and refusing to spend my emergency fund on opportunities. It also means acknowledging sequence risk. What happens if a downturn arrives early in my investing life or just as I need to draw? And sizing my cash and bond sleeves so an unlucky sequence becomes a bruise, not a break. If I were starting in 2026 specifically, I'd remind myself that the calendar year is just that, a calendar. The market does not reset in January like a video game. I wouldn't wait for a headline to bless my first contribution. I'd start now with the smallest viable automation and raise it on a known date. I'd assume the next decade includes a recession, a bull market, regulatory changes, interest rate swings, and stories that make everyone feel clever for a weekend. I'd build a plan that doesn't need me to be clairvoyant or brave, only consistent. I would also design my attention so my plan survives modern life. My phone would charge outside the bedroom so sleep, free performance enhancer, actually happens. Shopping apps would live 2 screens deep. My savings or broker app would live on page 1 as a queue. I'd keep 2 10-minute dinners, eggs on toast with fruit, pasta with jar sauce, frozen vegetables and a hard cheese, and a freezer pantry of prepped components, so "I'm cooked" doesn't become "I financed fries." I'd carry a tiny friction kit, water, snack, charger, so convenience stores stop renting my wallet. These aren't finance tricks, they are defenses for the human who has to keep the promises the policy makes. On the income side, I'd stop selling hours and start selling outcomes wherever possible. A quiet, compounding portfolio is magical, but the fastest way to improve your investing life is to raise the amount you can invest. Every 9 to 12 months, I'd ask for more money with receipts. Dollars saved, errors prevented, revenue created, days shaved, risk removed. If I were a freelancer or small business owner, I'd productize what I already do into clear offers with scope, price, and timeline, build a phone-first booking page, send same-day quotes with scope and expiration, invoice on delivery or milestones, and ask for a review with a 5-second link. The raises those habits compound as surely as my funds do, and they're under my control. Geography is a lever I'd actually pull. Proximity is profit. If moving closer to my life, work, clients, childcare, community saves me hours, I'd take the return of cooked dinners, sleep, a short walk, and a side engine I can actually service. If moving away from status pressure lowers my fixed costs and raises my savings rate without isolating me, I'd consider that too. Rent is an experiment, buying is a commitment. The question is not whether a city is cool, it's whether my week gets quieter while my slope rises. I would treat taxes and insurance as protective design, not entertainment. I'd contribute to tax-advantaged accounts on dates, not moods. I'd skim a fixed percentage off variable income for quarterlies the day it lands. I'd right-size insurance so a bad month doesn't turn into a bad year. Health coverage matched to how I use care, term life if someone depends on my income, disability coverage because my earning power funds everything else, and an umbrella policy over home and auto. Deductibles would match my buffer. Paperwork would be boring and findable. Beneficiaries, wills, powers of attorney, health directives, a where things live note another human could follow. None of this is photogenic. All of it is compounding. For learning, I'd pick a cadence that ships instead of a library I never open. Each quarter, I'd add one stackable skill that makes me a better earner or a calmer investor. Reading financial statements enough to avoid obvious scams, understanding cost basis and tax lots, building a simple spreadsheet for my net worth, or writing a one-page memo when I change my policy and why. 10 minutes a day, 4 days a week, 1 hour on Saturday to ship one small artifact. At the end of the year, I'd have 4 useful things and no decision fatigue. I would think in decades and track in quarters. I wouldn't check my portfolio daily. I would check the 2 numbers that predict whether future me will thank me. First, contribution rate. What % of income becomes ownership on payday? Second, months of buffer. How long can the household breathe without panic? If both improve over 12 months, I'm winning even if feeds say otherwise. If one lags, I'd turn the dials I actually control, raise income, trim fixed costs, adjust lifestyle, add ballast, not the dial labeled market. There are pitfalls I'd expect and write defenses against today. I'd expect an alluring scheme that promises to compress decades of patience into a week, and for my brain to want it. My defense would be that sandbox sleeve with a capped amount and a written rule that it cannot borrow from the core. I'd expect a nasty drawdown that makes me want to stop contributing. My defense would be to lower the contribution temporarily rather than move to zero, because keeping the Hobbit alive is more important than the amount for a few months. I'd expect a comparison spiral when a friend posts an upgrade that looks at a raise. My defense would be a slope and serenity scoreboard taped where my eyes drift in the kitchen. I'd expect a moment when I'm tempted to pause rebalancing because this time is different. My defense would be a calendar invite titled, "You are not special, obey the page."
If I were starting with very little, I'd begin small and fast rather than large and later. The first transfer might be a token $10 to each sleeve, buffer, investing, weekly card, just to establish the mechanics and the identity. Momentum is a form of capital. It buys better decisions tomorrow. And as soon as a small raise arrived, I'd give it a job for 90 days before lifestyle hears the news. My experience is that people who start with tiny automations get richer than people who wait for the perfect number to start with, because compounding rewards starting more than it rewards optimizing. If I were starting with a windfall, I'd resist urgency. I'd park it in safe cash for 3 months, write my one-page policy cleanly, and then phase it into the market on a schedule I can sleep with, either all at once if my nerves allow, or over several equal steps if I know I'll flinch. The math on lump sum versus averaging favors speed more often than not, but the math that matters most is the math I can obey. The only wrong choice is the one I will undo at the first red headline. If I were starting with a family, I'd convert chaos into logistics early. An ask-first threshold for purchases and 2 small no-questions allowances protect dignity and reduce friction. A 10-minute weekly check-in, what happened last week, what matters this week, any irregulars, one small joy we will fund on purpose turns money fights into calendars. Generosity would be scheduled, some mix of a steady percentage, a fixed monthly amount, and a small spontaneous fund, so it never argues with groceries. Money is for people. Treating it that way helps plans survive stress. If I were starting as a business owner, I'd separate household and business money even when both are small. A price book, same-day quotes with scope and expiration, deposits and milestone invoices, a pause clause when payments are late, and a 5-second review link are not bureaucracy. They're how you get paid on time so your portfolio can compound. I'd send a tiny skim to a taxes bucket from every invoice and set recurring calendar reminders for quarterlies, so April becomes a report, not a plan. If I were starting abroad or planning to move, I'd remember that diversification is not just a portfolio word, it's a life word. I'd keep emergency cash in a currency I actually spend, avoid locking everything into a jurisdiction I don't understand, and hold global equity exposure so my returns aren't a bet on a single flag. I'd keep records clean so cross-border filings are clerical. The goal isn't to be exotic, it's to be resilient to geography. And if I were starting with the fear that it's too late, I'd carry that fear to a table and write the ceremony anyway. Late plus focused beats early plus leaky. I'd shrink fixed costs until I can invest on payday and refill a buffer after life takes a bite. I'd add a little ballast so I can sleep. I'd raise my contribution rate 1 notch per year. I'd keep single-name exposure modest, especially if I work where I invest. I'd walk most days. I'd charge my phone outside the bedroom. I'd write receipts for the value I create and ask for more money with arithmetic, not adjectives. It is remarkable how quickly slope changes when drift stops. After a year of this, if I started in 2026, what would life look like? Not glamorous. The balance would be modest, the habits would be strong, Fridays would be boring. The sleep fund would have a number and a name. Contributions would leave whether the internet felt clever or terrified. The policy would have ink fingerprints and perhaps 1 revision date because I learned something true. My household would have fewer surprises because the irregulars stopped pretending to be emergencies. The car would start, the rent would clear, the kitchen would produce food often enough that delivery felt like a treat rather than a reflex. My raises would route through rails before lifestyle found out. And in the mirror, I'd see someone who doesn't need to narrate their plan because the plan no longer needs an audience. You can start this ritual tonight. Rename one account, staging rails, and route your next paycheck there. Create 4 automatic transfers: bills early in the month, sleep fund on payday, investing on payday, weekly card every Friday. Move recurring bills to the first week so drift can't spawn late fees. Write your 1-page investing policy in your own words and tape it where panic can find it. Start a receipts note and write down 1 thing you shipped, 1 thing you prevented, and 1 thing you improved today. Move shopping apps 2 screens deep and put your broker or savings app on page 1. Charge your phone in the hallway, cook 1 default dinner, and freeze a second portion. Cancel 1 subscription that fails the rebuy test and route the savings to a sinking fund with a name that makes you grin. Then let the weekly card reset on Friday. Not a perfect month, 1 well-designed week, repeated until your decade can't help but compound. The markets in 2026 will not read your feed. They will not reward clever captions, panic posts, or heroic speeches. They will quietly transfer wealth from the impatient to the patient, from the complicated to the simple, from the frantic to the repeated. If I were starting then, I would choose to be boring on purpose. Boring enough that my calendar looks the same in July as it does in January. Boring enough that I can sleep when screens go red. Boring enough that a windfall doesn't need a story and a setback doesn't need a villain. That's the kind of boring that makes a decade look miraculous, and all it asks is that you keep promises to yourself on dates you chose when the room was quiet.